Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host, Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
United Parcel Service was founded in 1907 in Seattle by a 19-year-old James Casey with $100 borrowed from a friend. More than a century later, it remains the world's largest package delivery company by revenue.
The business operates across three segments. U.S. Domestic Package handles the ground network, moving 21 million pieces per day. International covers air express globally. Supply Chain Solutions adds freight forwarding and logistics services.
The U.S. ground network is the irreplaceable moat. Building an equivalent hub-and-spoke infrastructure reaching every address in America would take trillions of dollars, decades of construction, and still face a massive brand disadvantage.
B2B commercial accounts are the most profitable and sticky customer segment. Daily scheduled pickups from businesses create contractual revenue with high switching costs because the UPS workflow becomes embedded in the customer's operations.
International package generates around 17% of revenue, but significantly higher margins than the domestic ground segment. Time-definite air delivery across 220 countries is a service no ground-only competitor can match.
The Supply Chain Solutions division handles customs brokerage, freight forwarding, and specialized logistics, healthcare cold chain, high-tech equipment, and retail distribution, adding revenue diversity beyond the core parcel model.
On the competitive landscape, UPS and FedEx are the dominant duopoly in U.S. package delivery. FedEx historically led in air, UPS led in ground. The two have converged significantly over the past decade with overlapping capabilities.
Carol Tome became CEO in 2020 with a mandate to improve margins rather than chase volume. Her better not bigger strategy prioritized revenue quality, higher revenue per piece, over absolute shipment volume.
The dividend is among the most generous in the S&P 500. At nearly $6.48 per year, UPS offers substantial income for patient investors who can tolerate the cyclical sensitivity of global logistics volumes.
The UPS Store franchise network, with over 5,000 retail locations, adds a consumer-facing dimension. Customers drop packages, access business services, and engage with the brand at the local level daily.
UPS operates one of the largest cargo air fleets in the world, with over 500 aircraft, a capital-intensive asset enabling next-day and international express commitments that competitors without air infrastructure cannot honor.
The long-term demand driver is e-commerce. Online retail shipments are structural. Every product bought online needs a last-mile delivery. As e-commerce penetration continues growing, UPS's parcel volumes carry a secular tailwind.
Healthcare logistics is a growing priority. Temperature-controlled pharmaceutical and medical device delivery is a high-margin, regulation-intensive niche where UPS has invested in specialized capabilities and certifications.
Serving over 220 countries, UPS has the geographic reach few logistics providers can match. That global footprint is essential for multinational corporations needing consistent, reliable delivery standards across all of their markets.
That's the company chapter for United Parcel Service. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
UPS delivered first quarter earnings per share of $1.07, beating the consensus estimate of $1.02, a 4.9% beat. On the surface, that sounds like a routine quarter, but context matters enormously here. UPS has been grinding through one of the most painful restructuring periods in its modern history. A bruising Teamsters contract negotiation in 2023 that locked in significant labor cost increases, a massive and deliberate reduction in Amazon volume, and a cost structure that expanded faster than revenue over the past 2 years. This quarter's beat is a signal that CEO Carol Tome's cost reduction program is producing real results, and that the volume mix is genuinely improving toward higher margin customers. Revenue for the quarter was $20.99 billion. UPS is not a growth story right now. It is a recovery and yield story. And this quarter provides the clearest evidence yet that the recovery is actually happening on the ground, not just being promised in investor presentations.
UPS is the world's largest package delivery company by U.S. domestic volume, operating one of the most complex and capital-intensive logistics networks ever assembled over more than a century of continuous operation. The U.S. domestic segment moves the majority of revenue through ground and air package delivery across a network of hubs, sort facilities, and delivery routes that took generations to build. The international segment, particularly in Europe and Asia-Pacific Express, provides meaningful diversification and tends to carry structurally better margins on time-definite premium shipments. UPS also operates a supply chain and logistics division serving healthcare, retail, and industrial clients with more complex fulfillment needs. The company's current chapter is defined by two overlapping structural forces: the financial weight of the 2023 Teamsters contract, which locked in significant labor cost increases with built-in annual escalators, and the steady planned reduction of Amazon as a customer as Amazon Logistics builds out its own last-mile delivery infrastructure across the United States.
Q1 2026 by the numbers: $1.07 actual versus $1.02 estimated, a 4.9% beat. Revenue of $20.99 billion. The revenue number reflects a business that is still absorbing the volume loss from the Amazon strategic reduction and the competitive disruption that followed the Teamsters deal. When UPS announced the contract terms in 2023, a meaningful portion of large retail shippers shifted volume to FedEx and regional carriers as a hedge against potential service disruptions, and winning that volume back has been a slow, customer-by-customer process. But the earnings beat tells a more encouraging story. The cost reduction program that management committed to, targeting over $1 billion in structural savings, is running ahead of initial expectations. Operating leverage is improving even before full volume recovery occurs, which is a genuinely positive leading indicator for what the income statement will look like when volume does come back more fully alongside cost improvements.
On the income statement, the revenue base of almost $21 billion reflects a deliberate mix shift that is positive for margin quality even where it looks neutral or slightly negative on the headline top line. UPS has been actively growing its small and medium business segment, SMBs, and reducing its reliance on mega shipper accounts like Amazon. SMB customers pay retail-adjacent rates rather than the deeply negotiated, razor-thin contract rates that Amazon extracts through its volume leverage. SMB customers are also stickier. They generally lack the scale to build their own delivery capabilities and tend to value service reliability over pure cost minimization. The margin improvement from this mix shift is a real and measurable driver in this quarter's results. Operating costs remain under structural pressure from the Teamsters wage escalator, which by design increases labor costs on a fixed schedule year after year, but the savings program is providing a meaningful offsetting tailwind. International margins were a bright spot, supported by solid European cross-border demand and resilient Asia-Pacific Express volumes.
The signature metric for UPS that experienced logistics investors track most closely is revenue per piece in the U.S. domestic segment. That is yield, the amount of money UPS generates for every single package it moves. UPS can grow revenue and improve margin either by shipping more packages, by charging more per package, or ideally, through some combination of both. Right now, total volume is constrained by the Amazon strategic reduction and the slow, methodical recovery of shipper accounts that diverted volume during the Teamsters uncertainty. So yield is carrying the entire burden of margin improvement in this cycle. Management's strategy to deepen SMB penetration directly and measurably improves yield because SMB shippers pay retail rates rather than mega shipper negotiated rates. Every single percentage point shift toward SMB within the domestic mix is a yield improvement event that flows directly to operating margin. That internal engine is what drove this quarter's earnings beat, not simply more boxes moving through the system, but materially better value boxes. When volume eventually recovers on top of that improved mix, the operating leverage should be very substantial.
Cash flow and balance sheet. UPS generates significant operating cash flow in normalized conditions. The package delivery business is highly capital intensive to build and maintain, but it produces reliable and predictable free cash flow once the network is established. The dividend is the absolute headline item for investors evaluating UPS right now. UPS pays $1.63 per quarter per share, which, at a current stock price around $130, implies a dividend yield of approximately 5.5% annually. That is an extraordinarily attractive yield for a company with UPS's franchise quality, market position, and earnings trajectory. The payout ratio is elevated relative to current earnings, which is the primary driver of the hold-heavy analyst consensus. Dividend sustainability is a genuine ongoing debate in the investment community. Management has explicitly defended the dividend as the top capital allocation priority, and the cost savings program is specifically engineered to rebuild the free cash flow coverage ratio over the next 2 years. Balance sheet leverage is manageable, and the credit rating remains firmly investment grade.
On capital returns, the dividend is the story full stop for most of the institutional holders in UPS right now. 5.5% yield at current prices is the primary reason income-oriented institutions continue to hold the stock through what has been a genuinely difficult restructuring period. The buyback program has been substantially reduced from its prior pace. Capital that would previously have gone to share repurchases is now being prioritized for maintaining the dividend and funding necessary operational investments. Management has been clear that once the cost savings program runs through its full 2-year execution timeline and domestic volume stabilizes at a defensible level, they intend to return to a more balanced capital return approach that includes meaningful buyback activity alongside the dividend. Full year 2026 guidance calls for continued margin improvement and modest top-line revenue growth. The guidance tone is deliberately cautious. Management is not getting ahead of the data on volume recovery given ongoing uncertainty around trade policy and broader consumer spending dynamics. The dividend commitment remains the anchor of the entire bull thesis.
Management commentary on this quarter focused most heavily on the execution progress of the billion-dollar-plus cost savings program and the measurable results of the SMB growth initiative. Carol Tome reiterated clearly that the savings target remains fully intact and that execution is on track with the communicated timeline. International segment outperformance was specifically highlighted as an area of strength. European markets showed solid demand, particularly in healthcare and cross-border e-commerce, while Asia-Pacific express volumes remained resilient despite broader trade uncertainty. The key forward catalyst that the market is most attentively watching is a stabilization or reacceleration of volume in the U.S. domestic segment. Volume recovery layered on top of the pricing and cost improvements already embedded in the business would produce dramatic operating leverage. That is the payoff scenario investors are underwriting by holding through the current difficult period. Secondary catalysts include the healthcare logistics vertical growing as a percentage of overall mix, as healthcare shipments are time-definite, high-value, and structurally command better margins than standard retail parcels.
Analyst ratings on UPS are heavily concentrated around hold, with a consensus price target of approximately $138 against the current price near $130. The price target implies modest 6% upside on the stock itself. But when you add the 5.5% dividend yield, total return potential over 12 months comes to the low double digits, reasonably attractive for a company with UPS's franchise quality, assuming the dividend is sustained. A meaningful minority of analysts sit at buy, arguing that the recovery trade is still underpriced by the market and that volume improvement will materialize as macro conditions stabilize. The hold-heavy consensus reflects genuine uncertainty, not pessimism, about the pace of volume recovery and the dividend payout ratio sustainability at current earnings levels. The street is not negative on UPS in a structural sense. It is cautious, waiting for a second and third consecutive quarter of evidence that the trough is genuinely behind them. This quarter's earnings beat is an important and meaningful step in building that evidentiary record.
Valuation. UPS trades at roughly 17 times forward earnings at current prices, which in the context of a business with UPS's competitive position is genuinely not a demanding multiple. The U.S. ground delivery network is one of the most difficult and expensive physical assets to replicate in American business. It has taken over a century of capital investment and route density building to create, and it cannot be meaningfully duplicated in any realistic timeframe. At 17 times forward earnings, you are paying substantially less than the 30-plus multiples commanded by higher-growth logistics and technology companies, and even less than some regulated utilities with far lower growth potential. The EV to EBITDA multiple at approximately 10 times is similarly reasonable by historical standards. The central valuation debate is not whether UPS is cheap on a static multiple basis. It is whether you are buying at trough earnings or at earnings still heading lower. If this quarter marks the genuine beginning of an earnings recovery cycle, then 17 times trough earnings is a very attractive entry point that generates strong returns. The analysts' target of $138 prices in a modest but confirmed recovery scenario.
Bull Case 1. The cost savings program delivers in full and on the accelerated timeline implied by Q1 results, and the earnings inflection arrives in 2026 rather than 2027, as some bears argue. UPS has made explicit public commitments to over $1 billion in structural cost reduction. If those savings materialize on schedule, and the SMB mix strategy continues to keep yield per piece moving higher, UPS's earnings power recovers toward prior historical norms faster than the current consensus estimates project. A stock with a low earnings multiple on a business where earnings are demonstrably inflecting higher tends to experience both earnings growth and multiple expansion simultaneously, which can drive very strong price returns in a compressed timeframe. Prior to the Teamsters contract disruption, UPS regularly generated significantly more earnings than it does today. The recovery math back toward those prior levels at even a modest multiple is compelling for investors who believe the cost program is working, and this quarter suggests it is.
Bull Case 2. The international segment outperformance becomes the growth driver that the market is systematically underweighting in its current analysis. UPS's international air express business, particularly across Europe and Asia-Pacific, has been holding up substantially better than U.S. domestic package volume through this entire restructuring period. Cross-border e-commerce growth, pharmaceutical and healthcare cold chain expansion, and time-definite shipments of high-value electronics are all growing end markets, where UPS's express international network commands premium per-piece pricing and solid margins. If international segment revenue growth continues to accelerate, driven by either trade normalization or ongoing pharmaceutical supply chain build-out, it could contribute enough incremental earnings to more than offset the ongoing domestic volume headwinds on a consolidated basis. International revenue per piece is structurally higher than domestic ground delivery, and the fixed capital base internationally is already fully deployed. Incremental revenue in that segment flows to operating income at strong incremental margins. The market's persistent focus on the domestic pain is leaving the international optionality significantly underappreciated in the stock price.
Bull Case 3. The 5.5% dividend yield creates a hard fundamental floor under the stock price and attracts a completely different and more patient class of long-term buyers. At that yield level, UPS's dividend competes directly and favorably with fixed income instruments for income-oriented institutional capital. If interest rates begin declining over the next 12 to 18 months, and the market has already priced in some expectation of rate cuts, the relative attractiveness of a 5.5% dividend from a blue-chip logistics franchise improves substantially compared to the declining yields available on treasuries and investment-grade bonds. That capital rotation from fixed income into dividend equities is a powerful and systematic buying catalyst that is entirely independent of UPS's operational recovery timeline. Management has defended the dividend with great consistency and clarity. Investors who believe that commitment is credible are essentially getting paid 5.5% annually to wait for the operational recovery to materialize. and that patience tends to be rewarded in situations like this one.
Bear case 1. Amazon's self-delivery network build-out is a structural headwind with no visible endpoint, and it is getting structurally more threatening, not less. Amazon currently represents approximately 11% of total UPS revenue, but that share has been declining steadily and purposefully as Amazon Logistics scales its own last-mile delivery capabilities across the United States. The more concerning long-term dynamic is that Amazon's internal delivery network is getting meaningfully better in quality, not just larger in scale. They are adding delivery density, improving on-time reliability metrics that rival UPS's performance, and expanding geographic coverage into lower-density markets where they previously relied on UPS. As Amazon's network quality improves, the incentive for third-party marketplace sellers to route their shipments through UPS rather than Amazon's own logistics diminishes systematically. Volume that Amazon captures internally through its own network cannot be won back by UPS, and the revenue associated with that volume loss is permanently gone. Managing a business facing structural account decline on one of its historically largest customers while simultaneously absorbing multi-year labor cost increases is an exceptionally difficult operating environment.
Bear case 2. The Teamsters' wage structure functions as a permanent inflation ratchet that compounds every single year, regardless of what revenue or volume is doing on any given quarter. The 2023 contract was extremely expensive at the moment of signing. It included substantial immediate wage increases across a very large unionized workforce that numbers in the hundreds of thousands. But beyond the initial increases, the contract structure also includes built-in annual escalators specifically tied to inflation measures that guarantee labor costs increase every year. In an environment where wage inflation remains elevated and sticky above historical norms, those contractual escalators keep adding to UPS's cost base year after year without any offsetting revenue mechanism. Unlike a price-linked contract structure, which is the core of WM's competitive advantage, UPS sits on the cost side of a wage escalator with no direct or automatic revenue offset. If volume recovery proves slower than the savings program can compensate for over time, and wages continue climbing on schedule, the margin squeeze can persist far longer than the street's base case currently models. That is the specific scenario where the dividend payout ratio becomes a genuine and uncomfortable sustainability question rather than a theoretical one.
Bottom line on UPS, this is a recovering franchise at a discount valuation with an exceptional and currently market-beating dividend yield. The first quarter earnings beat is genuine and encouraging evidence that management's cost reduction strategy is producing real results. Earnings are improving even before the full benefit of volume recovery materializes. The risk scenario is that the Amazon structural headwind and the Teamsters wage escalator prove more persistent and more damaging than the savings program can offset on a sustained basis, ultimately putting the dividend sustainability into serious question over a multi-year horizon. The reward scenario is a blue-chip logistics network trading at 17 times trough earnings, paying 5.5% in annual dividend income, while long-term investors wait patiently for the operational inflection to play out fully. For income investors who have conviction that the dividend holds and that the operational improvement trajectory is genuinely underway, UPS offers a compelling combination of current income and potential price appreciation at current levels. This quarter was a meaningful step in the right direction. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.